Hi, it's Pro Exam. We've been caught short a bit today in doing what we're doing. We're sort of having to update this from our mobile location and the mobile office. What we're trying to talk to you today is about property and living and working abroad. Uh, it's an interesting scenario because there's lots of different issues on it, and we're looking forward to a budget in the UK, which could actually result in quite big tax rises. But actually, the tax rises politically don't stack up if you want to just raise the tax rate. But actually, you can shuffle it about. You can call it a simplification of the tax system, of the allowances, of the rules, but end up catching more people in tax. And this is the $1 million question that we're going to look forward to in the uh, budget for expats. Now, if you are an expat, if you're living and working abroad and you're a tax resident abroad, there's things you can do now and there's things you can do before the budget. If you're not living or working abroad um, uh, and you're uh, want to take some action which involves offshoring assets or investments, you can still take action on that, not for you as an individual. So listen out for that. Is that you as an individual might not have time to relocate overseas before the budget, but what you can do is take steps to protect your capital and assets from um, uh, a tax creep in the budget in the coming weeks. With property, the key thing is that in the UK is that property capital assets are fixed in the UK, as are property rental income. So if you've got residential property that you're renting out, or you sell that property, then you're liable to either income tax or capital gains in the UK. Now, if you've got 12,500 of property rental income net of expenses in the UK and you're an expat, that uses your personal allowance, which is very tax efficient. So what are they going to do? Now, they can't reduce the personal allowance for everybody in the tax regime, but there's people sitting on asset investments, generated income, even though they're not necessarily in the UK, that are creating tax, saving tax in the UK. So what can the government do to make it fairer on what they call working people in the UK? Working people in the UK are earning up to £45,000. That's not um, the middle class London elites, metropolitan elites in their two, three, £4 million property that never worked in the private sector. We're talking about people that are working, earning up to £45,000. So what could they do with property assets? Um, so first of all, at the moment, you've got council tax. This is an annual tax you pay on your property, on council tax, which is great. It brings in revenue, pays for local services every year. But the central tax office doesn't get any money of that, the HMRC. Um, when you buy the property, there's a stamp duty which goes progressively higher. You can pay as much as 17% buying a property if you're living and working abroad and it's not your main home, and it's expensive residential property. But there's a lot of people that can get away with that. It's quite complicated tax for what it is. A big opportunity to simplify it. And then when you sell the property, uh, it's potentially principal private residence relief. So you get no tax on your principal private residence, but that's a grey area. If you're living and working abroad, it's not your main home. They've already started doubling adding 100% to your council tax bills for that. So you can double the income tax, but that's quite confusing. Some councils applying double the council tax for empty properties. Um, but if it's your own and main residence, why are they giving you personal private residence relief if you're living and working abroad. If it's rented out, um, it's a grey area. Immediately, you're sort of losing that right to rent abroad. And at the moment, you could have the property for, say, 9 months while you're trying to sell it and still have it treated as your principal private residence in theory. So a big opportunity to simplify stamp duty reliefs and capital gains tax reliefs there. Um, uh, so let's have a look at what that might mean. And I want to look at it in the context of a wealth tax. I keep talking about a wealth tax, but what does that mean? What it means is that when you earn income and you're earning your £45,000, the government are happy because they're getting income tax off you. They're also getting national insurance. Now, they might put up income tax at this time and reduce national insurance. But when they do that, if you've got a residential property portfolio in the UK and you get a rental income, that means you're going to pay more income tax. So that's good. That could affect people with a property rental portfolio, people with any form of leasehold income coming in the UK, or it could also uh, um, affect people with certain types of investment fund. So anywhere where you're getting an income in the UK um, off an asset for renting land or property, then that, it, if the income tax rate goes up, you'll pay more income tax. Conversely, um, they could reduce the national insurance down to say that the working people are still going to be paying the same amount of tax net. They may do that. They won't reduce the rate for an employer. So if you're an entrepreneur and you want to employ people, they're still going to charge you more tax for that. So the world is not going to improve in that respect as well. So we're left in this going round and round in circles position where the principal private residence rate gets more and more complicated, and um, the rental income from that becomes more and more complicated. So where can we go from there? So let's have a look at the wealth tax option. Says if you've got assets worth £1 million, we're going to tax you. It's not income, it's not a capital gain, it's just the fact that you own the asset, we're going to tax that. That's what a wealth tax will mean. So if you've got a property of £1 million, you've got an investment portfolio of £500,000, you've got a pension fund of another £500,000, and you've got some valuables or cash investments in the bank of another million, that's 3 million, where you not necessarily generating you an income, but it could be generating you an annual wealth tax uh, to pay out of cash on your capital asset. They might mark it up and they might allow you to defer paying that wealth tax until you sell the property. Um, you can't buy or sell your assets without a tax and chargeable event. So at the moment, that's marked by stamp duty. So you could abolish stamp duty, which they only get that money when you buy and sell the property. So it might be 18% when you buy the property, but if you keep that property for 20 years, they don't get any more tax from you. What about if you buy that property, you don't pay stamp duty today, but you pay 1% a year? So when you own the property for 40 years, you're paying more than double the amount of tax you're paying at the moment, um, and so it goes on. But it wouldn't just be your property; it could also extend to your other investments as well. So that's how a wealth tax works. So it could be 1%, it could be 2%, it could be 3%. You could keep a very high nil rate band. So with inheritance tax, you've got a nil rate band of 325,000. Great, fantastic. Um, Not gone up in more than 10 years. But if you had that with the wealth tax, it's only then going to be the wealthy people that are going to pay that tax. An individual can have the 325 exemption. So if you share the property or the bank account or the investment, it's half the amount. So you've still got your 325. So a husband and wife with 3 million assets, half it, 1.5 million, 325,000 allowance gives you 1150 taxable wealth tax, which gives you about 1,150 to pay a year. Thank you very much. Nice revenue income. into the government, then get tax financial credit on that to borrow more money, increase the borrowing in the British government even higher, and so it goes on. So that's what a wealth tax would mean. Now you can justify it by simplifying the regimes elsewhere. So everybody who owns property and investments and business in the UK has to pay 1, 2, 3% wealth tax. But you can then say we're going to abolish council tax. It's a very, very, very clean break. You can say that you're going to abolish the capital gains tax on the sale. I'm not sure whether they'll go that far, but it's still a way of mitigating that. But they could certainly abolish stamp duty as well. So council tax and stamp duty goes, and the central government collects in 1, 2, 3% wealth tax on the property. It's all tidied up, but then everybody's paying. And whether you're a UK citizen or an expat, you're paying this wealth tax on the property that you own. Landlords collecting rents will be paying their tax from their profitable income. If income tax rates have gone up, they're paying a higher rate. So being a property landlord in the UK could be a very ripe source of additional income tax and wealth tax revenue for the government. Now, they could call it a separate wealth tax, or they could just put up income tax. It's all politics, really. It's still going to be a tax for that. But think about more about your property. You've got principal private residence relief if you're an expat. But what if they decide to tighten up on that? What if they say if you're an expat living and working abroad and you own a property which you claim to be your principal private residence in the UK, it doesn't work? Why not clarify the rules on principal private residence to say that it's got to be the property that you're living in the UK? Now that suits most people. It doesn't suit everybody because some people might live in an apartment in London while their main family home is up in the north, or that they might have got a second job and they're relocated to another part of the country, and that the London home remains their main property. Um, so there are different ways that people cannot be living in the property. But if you're in the UK, those people can suffer. But if you're not tax resident in the UK because you're tax resident abroad, then it's a very easy step to say principal private residence is only available to people that are tax resident in the UK. You simply add on that caveat, principal private residence, you've got to live in the property, not rent it out, and be a tax resident in the UK. So if you're not tax resident in the UK, you can't get principal private residence relief. So that means all expats, all people owning property overseas. So if you're an Indian, Chinese, Russian, American, European investor in a UK property, which you use as a holiday home, but call your main home in the UK, your principal private residence, not only could they double the council tax, which you could do already, but instead, if they abolish the principal private residence relief or amend it and simplify it, is you've got to be a UK taxpayer living in the UK in that property to get that principal private residence relief. You're not withdrawing a very lucrative tax benefit for the individuals, but the people that it's going to impact are not voters or they're not people at home. And that is it could be a very, very simple way that they could increase their future rental income, property income take on capital gains, and redefine it without directly being accused of increasing taxes in the UK. Um, Given that they do that, then that puts more people in the capital gains tax. We've already seen capital gains tax increase by 80% from 10 to 18 and 24% last year. So that's massive. Now, the last thing that they may do is decide to simplify the tax rates. At the moment, we've got 18 and 24% capital gains tax. We've got 20, 40 and 45% income tax. we've got a ridiculously complex situation for people earning between 100 and 125 as they go from 40 to 45%. Why not clarify that? If you're going to increase your tax rate um, and reduce the national insurance rate as a way of generating more tax from people who are asset rich but income poor, then why not go the whole hog and simplify the tax system and hide in that simplification a way of increasing the taxes? So, for example, instead of 18 and 24 for capital gains tax, why not make it 20 and 40%? Um, uh, that would increase the capital gains tax rate and align it with the income tax rates. If you wanted to put up the income tax rates to 22%, well, why not align them with the capital gains tax rates as well? So why not make capital gains tax 22 and 40, or why not make 22 and 44? 22 is the basic rate, 44 is a higher rate. You can then say you're abolishing the 45% rate, but then everybody's going to have to pay a higher rate on the 40%. And but everybody will get a bit back on the national insurance, so the 2% on the basic rate earners is neutral because they get a social insurance reduction, um, but the basic rate applies up to £50,000 tax. So in the UK, the government defined working people under £45,000. So only people are going to pay more income tax if you increase the higher rate to simplify it from 40 and 45 to just one 44% band. It is wealthy people by their definition. So if you've got a property portfolio uh, that's in the UK, and the increase the basic rate of tax and the high rate of tax, you will pay more income tax on that. If you they tighten up the rules on principal private residence relief, then uh, there's less likelihood that you can own a property in the UK as your main UK residence and get capital gains tax exemptions. Capital gains tax rates could be aligned with income taxes to simplify, but have a net increase in the amount of take from people who are asset rich or income rich over £45,000. So there's lots to look at there, lots of potential scope on that. If you're already living and working abroad, what actions can you take? If you're living and working in the UK, what actions can you take to offshore uh, the changes before they come into effect? Well, there's effectively three ways. Um, you as an individual are taxable. So if you want to be taxable as an individual, uh, 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 and be free of UK taxes, you have to relocate overseas and live abroad. Um, that takes time. You need to get a residency permit, to get a tax number, and to register your pensions and your assets abroad. Uh, we can try that. If you're already tax resident abroad, you can make those changes now. You can gift assets. If you gift assets to family at the moment, you can gift them without capital gains tax. You can gift them with reduced capital gains tax and reduced stamp duty levels. So there are ways you can gift without stamp duty and capital gains tax now. You don't need to own the asset to enjoy it. And again, we can make those changes before the budget, but you need to act now because administratively there's a couple of weeks worth of work in that anyway. Uh, the third way is you could create a corporation to hold assets to protect yourself from wealth. Add a layer of charge, can work for some people. A very, very efficient way to do is to create a family trust. And if that family trust is located outside the UK, again, it can be attacked, but there's some ways of holding the assets. A trust is a separate tax entity, as is a company, as is an individual. So a family trust can hold business, property, and valuable and investment assets, and it can be non-resident to the UK and protect you from some of the UK taxes and the tax changes going forward. Those gifts can be made quite quickly and taken action. You still need a longer term plan. Uh, to take steps and to stop negative tax actions being taken by the government in the meanwhile. For more information and guidance on how to do that, to protect your family and income and business and wealth, whether you're asset rich or income rich, um, to pay the right amount of tax, but not more and more tax as it creeps upwards and upwards and into your um, assets, your capital gains, and your income. Contact us at proactpartnership.com. Thanks a lot for listening, and we'll see you again next time.